As we herald the start of April, they may be clapping at the Nasdaq and NYSE, but nobody is clapping for these markets. We're dealing with a rough and tumble of a spike in bond yields. We just had Invesco saying, calm down. This is an overreaction in the bond market, but perhaps not an overreaction in the Tesla stock, which is taking a bite out of the tech story this morning. Equities are on the back foot as we look for a market now that is ahead of the curve in terms of the Fed. The markets are now pricing less cuts than the Fed. That is a new dynamic for 2024. At one stock, I mentioned it, it is Tesla. It's taking a bite out of everybody's apple this morning. The EV maker suffering its first year-over-year sales drop since the early days of the COVID pandemic. Ed Ludlow is with me.
Manus, good morning. Tesla deliveries really missing the mark. In fact, this is the biggest Tesla deliveries miss versus Bloomberg consensus estimates for what it's worth on record. The stock is down 5.8%, 6%, had been down as much as 7%, a little more than 7% in the pre-market. In its statement, Tesla is talking about supply-side factors during the quarter that account for the lower volumes. Those include having to divert ships because of the situation in the Red Sea, but also a halt production in Berlin. You will remember that there was a fire incident which Tesla is labeling an arson attack, which impacted production in Berlin. Closer to home in Fremont, California, Tesla said that the introduction of a new Model 3, a refreshed Model 3, impacted production ramp. But here's the math that I don't get. The production miss relative to estimates was about 19,600 units. The delivery miss was 62,000 units. So deliveries came in the quarter 86,810. I think many will look at the numbers and say, we read what Tesla's saying about the supply side factors, but we don't buy it because look at the big widening gap between the production level and deliveries. There is a demand problem here. And as we speak to people throughout the day here on Bloomberg Television, I think we need to pose that question. There's been some volatility in the stock this period year to date. So a 6% move is no milestone to write home about. But this is a big miss, a big surprise, and it raises a lot of questions about not just North America, but demand for Tesla's vehicles in other markets like China and Europe.
Indeed. Well, we've managed to bounce by 2% since the pre-market, the first 30 minutes of this show, and where we are now, Ed Ludlow on the Tesla story. And we'll check in with that price as we go through the morning. What do you believe in terms of the cross assets? You've got the bond market spiking by 18 basis points over the space of 2 days. Invesco would say this is a complete overreaction. The Fed will cut by June. And then I have UBS this morning talking about 5 rate cuts going into 2025. That is very different to where the market is now, which is sub 3 cuts. And indeed, June is now the toss of a coin. Crude is up there as we see geopolitical tensions rising. We're at a 5-month high on oil, and Bitcoin down by 7.35%. That is an acceleration on the downside. We were off by more than 10% now from the record highs in March as we grapple with potentially less rate cuts, higher for longer, and a risk-off narrative as we jump into spring. Let's turn our attention to the insurers now. Humana falling as the U.S. regulators didn't boost payments for private Medicare plans, as was expected. Abigail Doolittle has the details. So we're seeing a bit of a pain trade for Humana and CVS. Abby, take it away on Humana.
We certainly are. Humana down 10%, the worst day since January. And that, of course, was when they put up a miserable quarter and really had to cut their profit outlook, having to do with the fact that more Medicare Advantage enrollees utilize the plans. That connects to the Centers for Medicare and Medicaid late yesterday saying that the payments to Medicare Advantage plans will increase 3.7% in 2025. That amounts to $16 billion, but it's much less than what the street and some of these companies had been expecting. In fact, it's also what they said in January. Despite the fact that these plans are being used more, that was why these companies lobbied to the Centers for Medicare and Medicaid to increase the rate more, but it simply didn't happen. Mizuho saying that the 2025 final effective rate, excluding assumptions of risk score trends, equals a decline. Wall Street had been looking for an increase of 1 percentage point. Right now, Manus, Humana on the year, including today's decline, down about 30%. That is heading to the worst year since 2008. Understanding that it's early in the year, but nonetheless, that's the degree of the selling pressure that we're seeing on this confluence of news.
Yeah, a couple of salvos across the market's bow over the past 24 hours. Abby, thank you very much. Let's pivot to entertainment. Disney investors will vote on the effort by the activists to reshuffle the board. We've got the Wall Street Journal reporting that Nelson Peltz is losing that battle so far. Katie Greifeld can give us the update. So a battle is going to ensue on this, isn't it?
Absolutely. Potentially the final chapter here of Bob Iger versus Nelson Peltz. Of course, Disney's annual meeting is tomorrow, April 3rd. And at the center of this dispute is really two things. You have streaming and you have succession planning. Let's start with streaming because Bob Iger, he promises that streaming profit is coming in 2024. Peltz, of course, pushing for board seats in an attempt to really stem those losses and also revive subscriber growth. And also at issue is succession planning. Remember that Iger, he extended his contract with Disney last year. He returned to the company in 2022, and who eventually replaces him is unclear at this point. And like you mentioned, you have the Wall Street Journal reporting that Disney is leading in its proxy fight with more than half of the votes counted thus far. But investors, they're still casting votes, and they can change them. You take a look at Disney shares right now. They're down mildly at the moment. They're up 35% in 2024, but still about 40% below their 2021 all-time high.
Bit of a reflection on the belief in Iger over everything else. Katie, thank you very much. Let's turn to the consumer space. We've got Calvin Klein, the owner, PVH, falling. That's after the company gave full-year sales guidance that fell short of expectations. Isabel is with me. Isabel.
Hey, Manus, PVH shares tumbled 21% in the open. That's the biggest drop since March 2020, and shares are now falling further, down around 23%. So the fourth quarter results were good, but as always, it's an outlook that spook investors, especially the first quarter and the full year outlook. So PVH is a company that owns Tommy Hilfiger and Calvin Klein, and the company said it expects revenue to decline 6 to 7% this year, and that's compared to the 2% increase we saw last year. And of course, some of this expected decrease stems from the fact that they acquired Heritage Brands, which is a women's innerwear brand. But still, the company also said it's generally the difficult, tough macroeconomic environment that we are in, especially in Europe. We have Evercore saying margin outlook for 2024 is, quote, significantly disappointing. And we have JP Morgan saying that declining growth in Europe is worrying and also cut its price target. For now, PVH is really working on strengthening its brands in Calvin Klein and Tommy Hilfiger, as we know that those two have lost momentum with shoppers in the recent years. For now, year to date, shares are up 22%, but it's looking like a bad day. Now shares are down 23%, Manus.
Isabel, thank you very much. My guest this morning is from Morgan Stanley. It is Andrew Sliman, and we're taking a look right now. Obviously, Tesla is our hot story, our hot stock. This is the Mag 7 year to date. Tesla is the laggard, down 33%. Let's just get an opinion on that. Mr. Sliman, good morning. We're being attacked on all fronts here, aren't we? We've got Tesla under pressure. I mean, this is brutal, down 5.5%, missing on the deliveries. We've got yield spiking by 18 basis points. Just a very first reaction to the Tesla news flow. Idiosyncratic to Tesla or something more malevolent?
Well, I think it's a good thing for the Mag 7 to be bifurcating based on fundamentals. If you look at the ones that are the winners and losers this year, it's all about fundamentals, and that was not the case last year. So overall, I think it's a healthy sign that the stock prices are reflecting what's going on in the fundamentals. And, you know, Tesla certainly, stock price and fundamentals seem to be going together.
So the bifurcation, I mean, you're going to hear people screaming from the sidelines, buy the dip on Apple, buy the dip on Tesla. The bifurcation will have ramifications in terms of performance for the rest of the year. I know that you've got a view on tech, and it doesn't necessarily coagulate around the top of the Mag 7, but you do like exposure in certain areas. How do you play tech?
Well, look, what's wonderful about this, what's happened recently, is if you think about the rally in the first quarter until early March, it was only a momentum, AI, weight loss drugs. It was all the same stocks. And then the market, those stocks kind of ran out of steam, but instead of pulling the market down, the market rotated into other areas like energy, financials, materials, industrials. That's a very good sign that people are looking for other areas to buy. And so I think, you want to own some tech names. I like some of the semiconductors that will benefit from the CHIPS Act. but I also like the cyclical areas of the market also, because I think this is not growth or value. I think it's a combination of both that you want. Now, I will caveat all this minutes by saying, look, last fall, when the conflict in the Middle East broke out, oil went down, and everyone asked me about geopolitics, and I said, I don't know, but I always watch oil. Well, oil is spiking higher. That means the concern by equities towards what's happening geopolitically is increasing, and that's something that we need to watch near term.
I mean, this oil price is rising. There we go. You're talking about the dangerous concentration and that movement in momentum stocks on wine, but it didn't have a brutal effect. The spike in oil this morning, let's talk a little bit more about that. How much of a challenge do you think that then becomes for the Fed? We'll talk about the Fed more broadly in a moment, but that oil spike, it's certainly not going to be welcomed by Jay Powell, nor the White House for that matter.
Without a doubt. Certainly the White House, you don't want to have people, being forced to fill up their gas tanks at higher prices right before an election. I think it's a problem. My base case is always, look, I think it's better for equities that the Fed doesn't cut because they're sending a message that economy is strong and they can be patient. I think that's a good sign. I'd be a lot more nervous if they were, hypothetically speaking, they were cut tomorrow. I'd get really worried that they see something that we don't see. But if they're not cutting because oil prices are higher, that's an inflation problem. And that's a concern. We'll have to see how this plays out. Look, I've been in the business a long time, and I've heard the secular thesis on oil forever. It never pans out that way. It rolls over eventually because higher prices always brings out more supply. We'll have to see, but near term, this bounce, I think, is a concern for equities after a very good run.
Well, here's the issue, isn't it, about where we are with rate cuts. Right now, we have the market assuming less cuts than the dots. Who'd have thought that we got there so quickly? So now we're sub 3. June has been shredded to the toss of a coin. We have oil lit up like a Christmas tree. I'm sure we'll get more notes at $100 oil in our inboxes, both of us. How would you react if there were no rate cuts this year, Andrew?
Well, again, I think they would be forced to cut rates if the economy weakened. So if you told me at the end of the year there were no rate cuts, my first reaction is, well, that means earnings estimates for next year are going to start the year somewhere, 275, 280. If you told me that they were cutting 6 times, I would go, oh my God, there's no way earnings are going to start the year at 275. So again, I think a patient Fed validates that the economy is strong. That's better for equities because as you think about where will the market end the year, it's going to be priced off of what is the forward earnings estimate for the S&P. And right now, next year is in the 275, 277 range. And that validates upside in equities. But if they cut 6 times or whatever, then that gets me worried. And then it's tougher to see a lot of upside in equities.
Let's put Morgan Stanley against UBS. I had UBS on this morning. They said 5 rate cuts in 2026. The fatter tail risk is a slowdown in growth. The fatter tail risk is a slowdown in growth, a material slowdown in growth because we've extrapolated too far. Now, the other side of that trade is, of course, China's rebounding in growth. Caixin is strong. ISM in the US is strong. And we are dragging ourselves by our bootstraps out of recession in Europe. Does growth hold up? How do you look at growth? And do you play that cyclically? Is that, I want to deploy more to cyclicality now because of perhaps this floor in growth?
Yeah, that's a great question. So look, in theory, as rates go up, inflation goes up. You want to play cyclical stocks, right? But if the market thought that the Fed was going to overstay their patience, you would see these stocks roll over, even though a little more inflation is good for them. And we're not seeing that right now. The best performing sectors the last 4 weeks have been the cyclical sectors. So the market is sending a message here that they think the economy can withstand Fed being patient. we'll have to see if that continues. But that's the message the market is sending. And so I think you do want to play these cyclical stocks because there is quite a bit of spread of valuation still between the cyclicals and the growth stocks. And what we're hearing from a lot of our cyclical companies is they have pricing power. They're raising prices, especially in the materials area, and that's good for the earnings.
Okay. Andrew, thank you very much for joining us. That is Andrew Sliman of Morgan Stanley on the markets. Coming up, EVs in focus. We've been tracking the Tesla price from the start of the show. We're down, as you can see, nearly 5.5%. Rivian down 6% as well. They unveiled their first quarter auto sales. We're going to pack it all in just a moment on the EV ride. Well, Tesla's suffering its first year-over-year sales drop since the early days of the pandemic. Meanwhile, you've got Rivian getting a boost after building more EVs last quarter than Wall Street expected. Both stocks are under pressure this morning. Craig Judell is back with me. We've gone from the preview to the finale, Craig, here, and the finale is brutal in terms of deliveries. Did Tesla play the wrong game by delivering or trying to go for the incentives?
I mean, they really threw everything at it this quarter in terms of, perks, supercharging miles. They threw temporary discounts out there. They even tried to advertise, which is something that Elon Musk, has made a name for his sort of detesting of advertising. They even tried that out in a more concerted way. For them to come this far short of consensus is the biggest miss relative to the average estimate that we've collected in data going back to 2017, 2016. So, this is really a pretty remarkable report. It's hard to find a silver lining here. You also had sort of accumulation of inventory, and that they produced quite a bit more than they delivered. And so a real question as to whether or not, this sort of whether this, pricing discipline that they tried to, put a face on this discount of $1,000 being temporary, something that would lift at the beginning of this month. It seems like it's only a matter of time before that discount, it sort of is brought back, perhaps, and then some.
What is the bigger issue here, Craig? Because you've had BYD snapping at Tesla's heels in China. You've got these reasons that they're giving. They had the Red Sea outages. They had problems at their factory in Berlin. What is the problem? An oversupply of better designed EVs or a Tesla-centric pricing problem?
I think we have to separate the two to some degree, just in the sense that BYD does play at such lower price points with a lot of its models, and has so much more of a lineup to work with. To Tesla's credit, they are able to get so much volume out of so few vehicles, and that really, on one hand, sort of is a positive for them in terms of cost. It is, sort of unusual in the industry to be able to have so much volume out of just a couple of models. On the other hand, we're seeing the sort of, way that is a double-edged sword, in that if you only have a couple of models to offer and you don't keep those models, regularly updated, they're going to get tired, and consumers are going to, be interested in something new and fresh. And so we're seeing the limits of that strategy for Tesla.
What do you think Musk does from here? I mean, he can be quite Machiavellian in the kind of his approach to dealing and grappling with, a tough day in markets, a tough day in the stock price. He's not going to instantaneously react, we don't think, but he's got to clear this inventory. How does he deal with this situation?
I think that's a really interesting question, and one of the things that you notice if you kind of spend too much time on Tesla's website is that on the sort of front end, if you want to sort of custom build your vehicle, you are quoted a certain price. Interestingly, in the last year or so, as they've so aggressively cut price and had some demand issues, they've moved to this model where you can order cars out of inventory, and those tend to be much lower price than otherwise. And so whether we see pricing deteriorate in a way that's less apparent for analysts, for investors, and whether that just adds to pressure on margins, I think that's going to be something that is going to be the focus in a few weeks when this company does report first quarter earnings.
Okay, well, they've got more headwinds coming, haven't they? They've got a new Cybertruck. Well, they've got Cybertruck headwinds coming, I should say, with Xiaomi with their new EV SU7. So the headwinds don't stop. Craig, great coverage through the morning, you and the team. Craig Trudell on the Tesla story. For some price action this morning, let's get back across to Abigail. She's got a lot to get through. Abby.
Yeah, absolutely. We have the S&P 500 down 1%. That is the worst day in about a month. At the lows, the worst day since the middle of February, down for a second day in a row. Not surprisingly, most sectors are lower, led by healthcare and that insurance news, down 1.6%, that the Medicare reimbursement rates won't be quite as high. Tech also down 1.6%, consumer discretionary on Tesla. So not a lot of places to turn. One bright spot, though, you can see energy there, up 0.9% in sympathy with oil. Oil right now rising at its highest level, essentially, or in the range of since the summer of 2022. And this, of course, on those recent OPEC plus cuts, plus rising geopolitical tensions. So you can see the oil service sector index, a subsector, up even more, Manus, up 1.7%. So at least there is one bright spot on the day.
Absolutely. All hail the oil and the oil sector. Abby, thank you very much. Coming up, market moving events for your diary. It's a lot of Fed speak on the slate right here on Bloomberg.
great questions.
Make sure you're logged in. This is what you need to keep an eye on. Joel Stead at the top of the hour. Fed speak. Williams, Mester, Daly all hit the tape. Wednesday, ISM services. Then we roll to Thursday and the jobless claims. Wrapping up the week with the jobs report on Friday. We expect 200,000 of a growth. The bond route is going global, from the United States of America to Germany and the UK. Perhaps the most malevolent moves in the UK, up 16 basis points, 18 basis points in 2 days in the United States of America.
We are 30 minutes into the U.S. trading day on this Tuesday, April 2nd. Here are the top stories we're following. Tesla's bad year gets even worse, with the EV maker suffering its first year-over-year sales drop since 2020. Vehicle deliveries fall well short of estimates. Shares plunge. Tough times at the gym. This year didn't deliver the post-New Year's pop to foot traffic that gyms usually enjoy. And you also have weight loss drugs posing stiff competition. Crunch Fitness CEO Jim Rowley joins in just a bit. And the final chapter of Bob Iger versus Nelson Peltz. The Wall Street Journal reporting that Disney is leading in its proxy battle with more than half the votes counted. We'll bring you the latest on the showdown at the House of Mouse. I'm I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You look at the markets this morning, and there is a lot of red on the screen behind me. You can see the S&P 500 currently off by about 1%. It doesn't help, of course, that Tesla absolutely dropping like a stone this morning, which we'll get to. Even worse, if you take a look at the NASDAQ 100, your big tech benchmark currently off by about 1.4%. And all the while, you have a sell-off in the bond market as well. You can see the 10-year Treasury yield currently up about 8 basis points. We are just about at 440. That is the highest level of 2024. And of course, we do have some breaking employment data right now in the form of JOLTS, and Mike McKee is here to break it down.
Well, Katie, if you want more support for the idea that maybe the Fed is going to be on hold longer, the JOLTS numbers can provide it. This is February data, but JOLTS, the number of job openings, actually rose in February, according to the BLS, in part because the number in January was revised down. So what we end up with is 8,756,000 job openings in February, compared with 8,748,000 in January. The initial report in January was 8,863. So it's a revision that makes the number higher this month. Hire's little changed, and the quit rate is unchanged at 2.2%, which has been the same for about 4 months now. Other numbers out right now: factory orders up 1.4% after a negative 3.8% decline in the month of January. Durable goods, as part of that, up 1.3%. That had been reported as 1.4%, but still fairly strong. Capital goods orders, non-defense, ex-air, the stuff that goes into GDP, unchanged from the initial release at 0.7% gain. So strength in factory orders. We saw that yesterday in the ISM manufacturing numbers, and we still have a lot of jobs to be filled.
And we also have a lot of jobs data to get through this week. Of course, we got JOLTS today. We have ADP, and then, of course, the all-important NFP. How does what we learned this morning set us up for the rest of the week?
Well, it suggests that there is the possibility of strong hiring, because at this point there are still a lot of jobs open. Now, we don't know how many are actual jobs and how many have been filled, but we do know that the average was about 5.1 million in the 10 years before the pandemic. So we're about 3 million over that, which leaves you a big hole to drive a lot of jobs through if you want to.
All right, Mike McKee, stay close. We're going to be talking to you a lot this week. Our thanks, of course, to Bloomberg's Mike McKee. And, of course, let's bring this conversation to the markets. And we're going to do that with Ellen Hazen. She is FL Putnam Investment Management Chief Market Strategist, joining us now. And, Ellen, let's talk about, of course, what we're seeing in terms of rate cut pricing and what we're seeing in the equity market, because it's a really interesting dynamic. You came into the year with markets pricing in, 6 rate cuts, and that was a reason for stocks to rally. And now, of course, you have all those rate cuts being pared back. I think we're at somewhere between 2 and 3 priced in, and still we're sitting on year-to-date gains of about 10%. I mean, when does that start to matter? When does that dynamic maybe start to flip?
Thanks for having me. And I think you've put your finger on it, Katie. That's exactly what we're watching. Earlier in the year, the market was expecting 6 cuts, and the Fed was saying in their December dot plot, no, that's far too dovish. We're more likely to have 3 cuts. And for the last 2 or 3 years, the market has been ahead of the Fed. The market has been more right, and the Fed has caught up to the market. But this time, the market has caught up to the Fed. And in the last 3 months, you've seen the market price in down from 6 cuts to 5 to 4 to 3, and now even below 3. And the key reason for that is the strong jobs data that you and Mike were just talking about. Every measure of the labor market has shown incredible strength over the last several months, whether we're looking at non-farm payrolls, whether we're looking at labor force participation, whether we're looking at average hourly earnings, whether we're looking at JOLTS, and so forth. That means that inflation is going to be higher for longer. That means that rates are going to be higher for longer. And this rally, as you started off by saying, of 10% this year so far, which is a good year in a normal year, it's too far too fast. We think that there's going to be volatility between now and the end of the year as the market digests the fact that rates are likely to be higher for longer. Now, what is going to cause the market to start to care about that? It could be anything. When markets are vulnerable, as they currently are, it can really take any very small thing, whether it's a hot CPI, hot PCE, or other information, but something will trigger it, and the markets are at risk of a pullback in the near to medium term.
Well, in terms of what could support markets further, you actually had J.P. Morgan weigh in a note this morning, writing that, of course, equities are ignoring the most recent pivot of a pivot, which might be a mistake. And their view is that earnings will need to accelerate in order to really plug the gap between, again, rate cut expectations and what the S&P 500 is doing. Do you view that as likely that earnings will accelerate from here further enough to actually justify what we're seeing?
I think it's unlikely. You're absolutely correct, and the folks at J.P. Morgan as well, that an acceleration in earnings estimates from here would justify potential further market multiple expansion and or allow the current multiple to maintain. But if you look at 2024 earnings and 2025 earnings estimates, they haven't moved since last summer. And so it's really hard to see what is going to cause those estimates to increase. For the prior year and a half before that, we saw a continued increase in earnings estimates as the operating leverage from that inflation-driven top-line acceleration continued and was unexpectedly strong. But we don't see that going forward. Earnings estimates for the first quarter haven't budged. For the full year, they haven't budged. For 2025, they haven't budged. And if earnings estimates don't increase, I think it's difficult to maintain the current multiple, much less the multiple expand from here.
So let's talk about what the rest of the year looks like, because it's only April 2nd, but it's never too early. You write in your notes that you're looking for mid to high single-digit equity returns in 2024, and we're already there if you look at the S&P 500. How do you expect the course of this year to go? Are we just going to flatline, or what does volatility actually look like?
I think what's most likely is that we see rotation and churn among different sectors within the large cap universe. I don't know that it broadens out to the small cap universe. Small cap estimates have actually declined, so I wouldn't go so far as to say the Russell 2000 is likely to be where the money goes. But I do think after the very narrow market we saw in 2023 and so far in 2024, the large cap market can rotate. And so you see some areas like healthcare and energy where the stocks have been pretty poor and the multiples are not that demanding. So I think what you see is the overall averages might maintain where they are between now and the end of the year with some up and down volatility. But I think you do see some broadening out within the large cap space to some of the sectors that have been left behind so far. And certainly the numbers we saw from Tesla this morning would support the fact that the Magnificent Seven is not a monolithic share gainer again this year the way it was last year.
Absolutely. You've definitely seen some dispersion even within those 7 stocks. But Ellen, you're sticking with us. But before I let you go, talk to me about cash. How does cash perform in this environment? Does it remain hot?
Absolutely. All of us have spent the last 15 years up until the last year and a half thinking that cash is trash. And clearly that's no longer true. And so particularly if the Fed is going to stay higher for longer in the short-term overnight rate, then cash is a very viable investment alternative. And we think it looks better than fixed income in certain respects because of the yield that you're getting today.
Yeah, and definitely a lot of people would agree with you, just judging on what we're seeing in money market funds. Ellen, stay with us. We're going to take a quick look at what's moving underneath the markets. We're going to do that with Bloomberg's Emily Grafeo sitting to my left. And Bitcoin, man, it's hurting.
It is hurting. We're seeing Bitcoin down about 10% since mid-March when it topped that 73,000 level. And often when we see Bitcoin fall, we see a lot of crypto-linked stocks falling. So I'm looking at Coinbase down 4%, and then a number of other miners, Marathon Digital, Riot Platforms, Hut 8 Mining, all down about in the 4% range. The idea here is that perhaps if the Fed pushes back the date of the first rate cut, that won't be good for speculative assets like Bitcoin. But if you look at Bitcoin's year-to-date gains, it's still up over 50%. There's still a lot of momentum in the ETF space, despite maybe some of the flows cooling down from the initial month of that launch. So, yeah, Coinbase down about 4% here.
Yeah, of course. Important context that you add there, that's on the back of, 50% gains in 2024. But insurers also having a pretty tough morning.
Yeah, Humana, one of the largest U.S. insurers, down almost 11% 1% this morning. And this comes after U.S. regulators yesterday didn't boost payments for private Medicare plans like the industry had come to expect. So the Biden administration announced that U.S. payments to Medicare Advantage plans will climb by 3.7%. But typically what happens in this industry is that the administration announces a proposed plan in January, and then they boost that number come the spring announcement. And that didn't happen this time. So it seems like the street not taking that well. We're also seeing competitors, United Health, CVS, also falling this morning on the back of that maybe lesser than expected boost to these insurance payments.
And if you think that's bad, take a look at PVH. Biggest drop since 1987.
Since Black Monday. I had to look at that twice. I'm like, wait a second, that was a really long time ago. Yeah. The earnings, I mean, for the fourth quarter actually beat expectations when it comes to EPS, when it comes to revenue, but the street really seems to be focused on the full year sales guidance, which was lower than consensus. PVH is the owner of Calvin Klein, Tommy Hilfiger, among a bunch of other retail brands. They noted that difficult macroeconomic backdrop in Europe could be weighing on the company, but overall, it's unclear exactly why the stock is down that much, 22%. We saw JP Morgan cutting their price target to 146 from 165, but they still have an overweight on the stock among a lot of other overweights on the street.
Yeah, it'll be really interesting to see if this turns into a buying opportunity because as you point out, I mean, the actual earnings weren't that bad. It's just the outlook, though, that always gets you. Bloomberg's Emily Grafeo, thank you so much. Now, coming up, Tesla shares sinking after seeing its biggest sales miss since the early days of the pandemic. More on the EV maker's troubles next. This is Bloomberg. Well, Tesla shares currently down about 5% after a huge deliveries miss. Of course, it's one of the worst performing names on the S&P 500 today and the worst performer on the year. Bloomberg Technology co-anchor Ed Ludlow joins me on set right now. Talk to me about the deliveries miss. What were the dynamics that led to that?
So Tesla is saying that these were supply side factors, that in the quarter gone, we remember what happened in the Red Sea. Tesla was one of many companies that had to divert both parts part shipments, and I'm assuming the delivery of vehicles that were built either in Berlin or in China to export markets. Tesla also was impacted in the quarter on the supply side by the fire at the Berlin plant, which impacted production. But I just don't think anyone's buying that. You know, this is the biggest miss that Tesla has had relative to Bloomberg consensus on record. And we know the factors that were at play: higher rates impacting the consumer, competition in markets like China, overall decelerating EV demand, and as one analyst has told us this morning, Gene Munster, Elon hurting the Tesla brand in the quarter.
So there's a lot of factors there.
It's a lot, yeah.
Let's focus on the demand part, because if this is a demand issue, in addition to all the other headwinds you outlined, but how do you fix a demand issue?
Yeah, it's interesting to see the strategy from here on in. Tesla heavily discounted and incentivized in North America in particular, beyond the available federal tax credit incentives at the end of the quarter, in an effort, as they always do, to get a real bump in deliveries in the final few days of 1Q. I was, as you know, one of those people that leased a Model Y. And then it did exactly what it said it was going to do: raise prices April 1st. In China, there's an interesting comparison where Tesla raised prices. Again, Tesla told us they would do that at the start of the second quarter. But look at the peers, NIO, XPeng. They've actually doubled down on incentives and effective price cuts. So Tesla was the leader in this market in using price as a lever. They cut prices and they've raised prices. And the net end price is important. But it wouldn't be surprising for them to then, next quarter also look at lowering the price or raising the price, particularly while rates remain higher. And that is something that Elon Musk has talked about.
So maybe expect more price adjustments, of course, as Tesla plots a path forward from here. Let's also talk about Rivian. Rivian was interesting because, of course, they actually beat on their delivery targets. We're talking about much smaller numbers here than Tesla, but still beating there. The stock, though, is down right now.
As you know, I've covered Rivian for a long time. I know the company pretty well. For me, this is a story about a management team learning corporate guidance. In the last quarter's earnings, they said deliveries will be down 10 to 15% in 1Q, and our production will be impacted because we're introducing new parts. We're reestablishing our supply chain. And they gave that guidance and quite comfortably beat it, particularly on deliveries this morning. But they're still constrained, right? They plan some downtime at the plant this year. And like Tesla, there is a big demand question mark around Rivian because they have these next-gen cars that go into production 2026. The market for $80,000 pickups and SUVs, it's not clear who's still buying those. And so they talk about doing a lot of test drives and demos. They did outperform relative to consensus on deliveries. How long that lasts, we'll see.
A lot of big questions there for both Tesla and Rivian. Bloomberg's Ed Ludlow, thank you so much. And let's get back now with Ellen Hazen. She is Chief Market Strategy at FL Putnam Investment Management, still with us. And Ellen, before the break, of course, we were talking about tech and this potential rotation that you see coming. So at this point, would you be among those maybe stepping away from tech, lightening up on tech, even as, of course, tech, for all the dispersion that we're talking about in the Magnificent Seven, continues to lead this market?
I do think it makes sense to trim tech, and particularly those areas that have done so well this year. So you look specifically, of course, NVIDIA, but even outside of NVIDIA, a lot of the chip makers, a lot of the semiconductor capital equipment companies are up 20, 25, 30% or even more this year. And now they're fairly valued. When we started the year, they were somewhat cheap. And I think it makes sense to trim the tech this year. I think you can tie that back into the Rivian and Tesla story, right? A lot of the reason why those numbers from Tesla were lighter have to do with rates and the impact that higher rates have on capital equipment and capital equipment purchases. Rates do affect demand for hardware, and I think that you're going to see the same thing in tech, not as much as for cars or houses, but you do see the same impact. And given how far the stocks have run this year, I think it makes sense to cut back on some of them. There are some areas of tech that are a little bit more attractive. Some of the software names, some of the services names look pretty interesting. But in general, tech has run pretty fast. And so we would be taking some money off the table and putting it into some areas, as I said, like healthcare, maybe some industrials that haven't done quite so well this year.
Well, let's talk about what the catalyst for some of those underloved areas of the market would be. You think about healthcare in particular. We talk about healthcare all the time, especially in the context of GLP-1s. But what would be the catalyst for the sector as a whole to rise back up here and maybe take the leadership baton?
I don't know about taking leadership. I think it will chug along and do okay. It will be like the tortoise in the tortoise and the hare fable, right? It can do okay. It can chug along. It's fairly inexpensive. So you can look at some pharma companies. Obviously, Lilly has done very well and Novo Nordisk has done very well, but some of the other ones are fairly inexpensive. They pay nice dividends, and you can buy those and just hold them, and it will stabilize. And so when I say that they'll take the leadership mantle, I don't think they're going to be up 25% from here, but I do think that they can outperform some other areas. I think the insurance area is one to be wary of, as we saw this morning, and it's not just the Medicare reimbursement rates, but just generally inflation hurts healthcare reimbursement. It becomes more and more expensive for healthcare, and that is going to reduce demand for healthcare in general. So I'd be a little bit more cautious on the insurance and the hospital front, but some of the devices companies look pretty interesting, and of course biotech is always interesting as well.
Biotech is always interesting, and of course, once those drug trial results roll through, if you're looking for volatility, one of the places to look. So staying away from insurers, but healthcare broadly, definitely see your point there. Where would you outright avoid? You mentioned that you're trimming tech, you're positive on healthcare. Where, when you look in the markets, do you just see, I don't want to be there?
Well, I'm still cautious on regional banks and smaller banks because of the exposure to commercial real estate. Even though everybody knows that commercial real estate is likely to be problematic, particularly the office area, it's still not reflected in the regional bank valuations. They're not that cheap, and this takes years to unfold because the leases are so long-lived that it takes a long time for the buildings to have lower rental roll rates and for pricing to come down and for the banks in turn to have to either seize the collateral or write those down. So even though it's well known, I think it has a very long tail. So I would stay away from regional banks. There are also some areas that have gone ex-growth that I'm more cautious on. So you look at something like Verizon and AT&T, where you have area or Comcast, for example, that are just not growing, right, as people are cutting the cord. And if you have negative growth or very, very slow growth, it's hard to make a lot of money there. So I would stay away from some of the very, very slow areas that are facing secular headwinds.
All right, Ellen, that's a good place to leave it. Really appreciate your time this morning. Our thanks, of course, to Ellen Hazen. She is Chief Market Strategist at FL Putnam Investment Management. Now, still ahead, we're going to take a look at the companies making the most social buzz today, and that's our Social Climber segment up next. This is Bloomberg. All right, time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Google will be deleting billions of browsing data. And this is part of a settlement for a lawsuit that accused the company of improperly tracking the browsing habits of people who thought they were doing so privately. Next up, we have Citigroup implementing a fresh round of job cuts, laying off 430 employees as it undergoes a planned restructuring. Technology, media, and telecom will be among the areas hit the hardest. Now, this reorganization is designed to streamline the bank's operations by eliminating 20,000 roles, as announced by CEO Jane Fraser earlier this year. And finally, we do have Petco really in the doghouse with Bank of America getting a double downgrade to underperform, also a price target slash to $1.50. Bank of America saying the company has lost much of its competitive bite. Now, coming up, we will be speaking with Jim Rowley. He is the CEO of Crunch Fitness. This is Bloomberg. Well, if you skip the gym as your New Year's resolution, you're not alone. After rising more than 40% over the past 2 years, foot traffic to major gyms actually was flat this year. That's according to Placer.ai, which tracked location data through mobile phones at the top 10 chains. And I'm really pleased that joining us now is Jim Rowley. He is the CEO of Crunch Fitness. So let's talk about that data. Of course, the finding that foot traffic to the major gyms flat from January 2023. When you look at your business and, of course, the foot traffic going into Crunch, did you see a similar softness there?
No, actually, according to Placer, we were up 21.1% year over year. So we led the industry in terms of foot traffic, which very proud of.
And what do you think led to that dispersion? Of course, you look at some gyms, Planet Fitness, for example, not seeing exactly that boost that you would typically expect coming out of the New Year's holiday. What did Crunch Fitness see?
Look, I think our members are more active than Planet Fitness. That's been widely stated. Our members are more fitness focused, they're goal oriented and so forth. So that's not a surprise to me. I also think because Crunch offers so many different amenities under one roof, as the boutiques closed during COVID and people stopped specializing, say, in just going to a SoulCycle class or a stretch class and so forth, Crunch offers all of those things under one roof in most of our facilities. So high attraction for people that we call young, strong, and social. That's our target market, 18 to 34. And they work out more than 4 times a week, which again is twice it leads the industry by 2 workouts per week.
Young, strong, and social. That's a good description there. Let's talk about sort of the price sensitivity when it comes to that cohort, that 18 to 34-year-old or so. I was looking on the website. It looks like I can get a month-to-month subscription for about $100 a month. What does the decision-making process look around your pricing? $100 a month. For a lot of people, that's a lot of money.
So a $100 a month price point is in our deep urban centers, New York, Miami, San Francisco, and LA. Our other 450 gyms, our base price is $9.99 to start. So we offer price points really based on geography. What drives the price point is really the cost of commercial real estate, the cost of minimum wage, the cost of doing business. In New York, it's just a much more costly place to do business, so the prices are increased. But we've got memberships as low as $65 in some of our deep urban centers. The $100 price point is really for an all-city Crunch, so you can move from location to location. Say if you're in Manhattan, you live on the west side, and you work downtown, you could have gyms in both areas.
Yeah, and it definitely makes sense that varies by location. New York, it feels like everything involved with living is more expensive. But let's talk about where Crunch falls in the industry, because you have 2 models, it feels like. You have the low-cost membership, high-volume Planet Fitness, for example, that's $10 to $20 a month. And then on the other end, of course, you have Equinox, which is much more expensive, more of a lifestyle. It feels like Crunch is operating right in the middle. Is that where you want to stay?
I wouldn't say we're in the middle. I'd say we're on the high value, low price on one end, which is our $10 base membership. And then we're at about $100, as you indicated, which is $100 or $125 less than Equinox and Lifetime in cities like New York. So we sit just below those premium gyms where, like you said, they're more about lifestyle. We're more about the concentration on fitness. And so we like that price point because it allows us to attract a whole different member set.
And I am curious about the cost of doing business for Crunch, because you mentioned, for example, commercial real estate. And actually in your notes you sent over that you have leased more commercial real estate than any other fitness company in 2023. When it comes to your physical footprint, how are you feeling about that? Obviously the commercial real estate sector, it's a headache and a worry for a lot of investors.
Yeah. It's interesting because I keep telling everybody who will listen, bring us every 20 to 45,000 square foot box that parks well, that's in a good sector of town. We don't have to be on Main and Main, but that's preferred. But if you're a realtor out there, or you're a landlord or broker, we are trying to find as many sites as possible. And we're actually finding it relatively difficult because our appetite to grow is significant. Our franchise owners are doing a tremendous job. We want more real estate.
Interesting. It's interesting, of course, to hear that fresh perspective. I mean, how many gyms does that translate into? You would like to grow here. What's the target in terms of how many gyms you would like to expand into?
This year or in total?
This year and in total. Let's do both.
So we'd like to open 75 gyms this year. We'd like to open north of 100 next year, which is 2 gyms per week. And we believe we've got white space north of another, call it 2,000 opportunities in the domestic U.S., not including our international sites.
Well, you'll have to come back and tell us how that's going. But let's also talk about one of the hottest topics of this year and last year, and that, of course, is weight loss drugs, those GLP-1s. The Ozempic effect has been felt by almost every industry, whether you're in snack food, whether you're in clothing. How is it being felt in the fitness industry?
I don't know that we've got the full gravity of it yet. I think it's starting to, we're starting to get some traction around it. You know, Crunch is, we're open to everybody wherever they are in their fitness journey. So if this gets more people considering exercise as part of the multifaceted approach, because I don't think it's just an injection. It's not just a diet. You've got to exercise. What we do know about the drug is it does have a muscle wasting effect. So we're happy to hear that doctors are encouraging people to get into the gyms before they start the GLP-1s to build their muscle up. And then to continue to work out to maintain muscle while they're on the drug. We're encouraged by that, and we're open to everybody wherever they are on their fitness journey.
That's really interesting. So rather than being necessarily a negative, people saying I can just take these medications and then not have to go to the gym, actually it could turn into a positive for you because maybe they lose all their muscles in the process.
Right. So look, a healthier population, we believe, is more inclined to exercise. So if this is their start, if it's the catalyst for those people in that category, we're here to meet you where you are. And we've got personal trainers that can help you. The other thing is that we've been reading and learning about from the science of this is that there's micronutrient, a lessening of micronutrients as well. So part of this is diet and nutrition and then supplementation. So we sell protein powders and other things that can help pick up the micronutrients that are lost while using the GLP-1s.
All right, Jim, really enjoyed this conversation. Hope to continue it again soon. Our thanks, of course, to Jim Rowley. He is the CEO of Crunch Fitness. A really interesting conversation on the state, of course, of the fitness industry now that we're past that New Year's rush. But let's get a check on these markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
Well, we're seeing some pretty brutal selling pressure, Katie, here for stocks overall. The S&P 500 down about 1%. Its worst day at one point since February 13th, off of those lows, but not a huge difference. You can see the NASDAQ 100 down more, down 1.4%. But it's also a broad-based sell-off. Chips down more than 2%. And then take a look at the small cap index, also down 1.7%. So there aren't a lot of places to hide. This, of course, is there's fears that the Fed won't be cutting as much or as early as expected. In fact, if we take a look at the two-year yield, suggesting that investors are really waking up to this idea over the last stretch of time, up about 20 basis points, but overall at a 470. So not so far away from that psychologically important 5% mark. Could we get some data that would bring the yields higher yet to pressure stocks on liquidity? Idea is that liquidity is not as abundant as folks would hope if the Fed were to cut. As for stock movers beneath the surface, we've got some real doozies here. Take a look at Tesla, down 5.7%, of course, on that big production and delivery miss. I believe the delivery miss the worst on record, double digit from a percentage standpoint. Humana down 14%, its worst day since January. This, of course, as Medicaid plans won't be reimbursed to the greatest degree as expected in 2025, as some of the plan participants utilize the plan more, so they're really getting hit from both sides. PVH Corp down 23%, the worst day since 1987. This, of course, is the owner of Calvin Klein, basically gave a disappointing outlook for the year, weakness in Europe. And then finally, Apple, which has been in a correction for quite some time, down to about 0.7%. In fact, Katie, because Apple is one of the biggest components of the S&P 500 and the NASDAQ, let's take a look at the technicals here to see what could be the case, because Apple is hitting down an important support. We've been tracking this for a while, concerned about the fact that the last peak is in December. But if we put this into the context of last year, you can see overall this area of congestion or a range. Now, if Apple were to trade back up into the range, we don't know what way the range is going to break. A range is basically a battle between the bulls and the bears, the sellers and the buyers. However, if the range does not hold, this is a massive topping pattern suggesting we could see a very, very large drop for Apple on top of its greater than 10% drop from the December peak. again, because of the weighting to the major indexes, that might be a possibly bearish message for the S&P 500 and the NASDAQ. One reason perhaps that we're seeing some of the selling that we're seeing now for those major indexes.
Well, we will definitely be keeping a close eye on that range when it comes to Apple. Bloomberg's Abigail Doodle, thank you so much. Now coming up, BlackRock's tokenized fund has brought in over $240 million since its debut. We'll take a look at its significance with Carlos Domingo, Securitize CEO, next. This is Bloomberg.